What's up, audit fans, and welcome to Module 6, the last module in this subject. So we've split the module into two parts. Today we're going to look at completing the audit, and in the next module we're going to look at audit reporting. So what are we going to cover in this topic? Well, we're going to look at auditing contingent liabilities. We're going to cover a whole lot of things that we tend to do just at the end of the audit, and contingent liabilities is one of those. The next one is events that arise after the balance date, things that we'll find out as the auditor after the end of the financial period. Obtaining representation letter from management. This is a really important piece of audit evidence we're going to talk about. How we evaluate all of our audit evidence. What do we do with it? How do we collate it and look at it all together? And then finally, assessing going concern. Now, this particular topic is a highly technical topic with specific auditing standards requirements for assessing going concern and events arising after the balance date. You'll see special little stars there that tell you to read the auditing standards in more detail. I do expect you to read those standards because those are really our replacement for our textbook. So let's look at the context of this week's topic. And I'm going to start from the beginning part of the audit. At the beginning of our subject, we learned that we needed to consider risk. We need to consider risk in helping us plan out our audit. And our plan will be to give us some sort of audit strategy that allows us to collect audit evidence that we're going to use to generate our audit opinion. And there's lots of other stuff that fill in here, in terms of risk. We know that we need to have our audit risk model, and to be able to actually do that audit risk model or implement that audit risk model, we know that we need to follow ASA 315 and understand the client. But what we haven't talked about is really there's a whole lot of steps that happen in between we've got our evidence and we need to generate our opinion. And they sort of, we don't want to do them while we're collecting the main bodies of evidence about all of our income statement items and our balance sheet items, but they just tend to be lumped together at the end. So that's the part that we're going to look at today. And then in the next topic, then we're going to focus on the opinion and the reporting components. So when do we start all of these activities? Well, we do all of these, as I mentioned, after we've conducted the bulk of our testing. So some of these things will link to some of the items on the income statement and the balance sheet, but these are typically things that aren't related to everyday transactions and the running of the business. They're specialized topics. And most of these tasks are conducted by auditors at the manager level and above. All right, so these are topics where we're seeing potentially increased judgment that is needed, and also additional levels of experience in dealing with clients, in dealing with these situations, so that we can evaluate them appropriately. When you start on an audit, everybody almost always starts auditing cash, sales, or accounts receivable, the same accounts we've talked about in this subject, because they're good entry points into the audit. But as you get more experienced, you'll be brought into more of these types of tasks. But just remember, these are tasks and judgments that managers and partners are making, so don't expect to be able to make these perfectly straight away. So our first component here is auditing contingent liabilities. And contingent liabilities is really about observing or applying the conservatism principle. And if you can remember your introductory accounting, we've got things like the entity concept. The conservatism principle is one of those. So remember, from accounting standards and regulations, you looked at contingent liabilities, provisions, and contingent assets. So it's really important to remember what our contingent liabilities are. So we've got a definition here that comes out of AASB 137, paragraph 10. It's a possible obligation that arises from past events and whose existence will only be confirmed by the occurrence or non-occurrence of one or more future uncertain future events. And that's things outside of our control. So something has happened in the past, which means that something may or may not happen in the future, which may or may not result in a liability. So these we call contingent liabilities. All right. The other option in which we may have a contingent liability is where we have a present obligation, but it's not recognized as a liability on a balance sheet because there is not probable that an outflow of resources is going to be required, or that we can't measure that amount with sufficient reliability. Now, normally, in terms of evaluating contingent liabilities, quite often it is this option here, B Part 2, which prevents some things from being measured as liabilities. So regular liabilities, where we have an obligation, those go on the balance sheet, but contingent liabilities, as per that last point there, they are not recorded on the balance sheet. Instead, they're typically recorded as disclosures in the notes to the account. So we're normally going to see these as disclosures. So we record these because we have 3 principles about accounting related to this. So the first one is about that we should have full disclosure. Okay. The second one is that these could be material. So there's the materiality principle here. And the third one is the conservatism principle, which is sometimes called the prudence. I find prudence, it just doesn't convey the same meaning to me. It's always going to be conservatism. But those principles also say, well, look, just in case, let's give the shareholders and the users of the financial report more information than less. So here's some examples of contingent liabilities. Of product warranties is going to be some of them. We will often have a provision for a product warranty, but potentially if you find one issue with a product that could blow up into a much bigger issue, that we could need to include a contingent liability. A lawsuit, so if somebody is planning to sue us, or we usually suing us, will result in a potential liability. We don't know whether we're going to win or lose, which is why we don't record it as an amount. If we have a disagreement with the ATO and we're arguing over a tax ruling, then that could affect our future tax liabilities. Or if we guarantee the debts or loans of another entity. So if we're a parent company, we have a subsidiary, we agree to pay their debts. If they can't pay, that could create a contingent liability as well. Now, this is not an exhaustive list, but these are the common sorts of ones that we will see as auditors. So what auditing standards do apply? ASA 500, which is about audit evidence. We've already looked at ASA 500 quite a few times. Oops. There's also a different standard that we haven't covered before, which is ASA 502. And ASA 502 is about litigations and claims. I'm going to talk a bit more about that particular standard a little bit later. And then also ASA 540, where we're auditing accounting estimates. So anytime that if we are going to include disclosures about a contingent liability that doesn't include some number figure, we also do need to consider, how is this estimate put together? Was it put together appropriately, or do the calculations not make sense? So which assertion is most applicable when auditing contingent liabilities? Well, remember all of our assertions. This is a disclosure, so certainly our presentation assertion. But we also need to be really worried about completeness. Most people are unlikely to record a fake contingent liability into the notes of the financial statements. We can't really accurately put a dollar value on them, so accuracy, valuation, allocation is not going to be an issue. We're not so worried about cutoff or classification, so completeness is going to be the big issue here. Have we included all of the contingent liabilities? Could there be some that are missing that haven't been included? That could be really big showstoppers. So for us, that's really difficult. You're trying to find a potential liability that definitely doesn't exist. So it's going to be quite difficult. And I'm going to talk about on our next slide how we actually search for information on contingent liabilities. So in terms of applying the standard, this is AASB 137. So we have to start with, let me get my pen ready. Is there a present obligation as the result of a past event? If there is, so it's a real present obligation, then we just go down the path down here, and that path is just real liabilities, okay? So it's not even contingent liabilities. That's a real liability on the balance sheet. Now, if there is a possible obligation, you're not sure, oh, yes or no. If there's no possible obligation, we don't do anything. But if there is a possible obligation, we don't know how much it could be, then we go down the contingent liability route. You may also go down the left-hand side there. If there's a probable outflow, but we can't reliably estimate it, then we also go down that contingent liability route as well. Now, management are supposed to be making these judgments. So they're meant to be looking at all of their potential contingent liabilities and following this flowchart. Our responsibility is to look at what management are disclosing and say, okay, have they applied this accounting standard correctly? And is there anything that might need to be included that we haven't included so far? So how do we gather this sort of evidence? Because trying to find things that could or could not be included that might result in future obligations can be really difficult. So we have to look at the disclosures prepared by management, because management should already be disclosing this in their notes to the financial statements already, and comparing those disclosures to our AASB requirements. All right, so that's AASB 137, and depending on what the disclosure is about, or the contingent liability is about, there could be other standards. We're also going to look at the board meeting minutes. So the board meeting minutes are when the board gets together, oh look, there's this lawsuit coming up, we're thinking about buying this other company, we're agreeing to give somebody a loan. So the board meeting minutes might have a lot of information that hasn't resulted in actual transactions yet, but could be really useful for us. The third thing we're going to do is think about discussions with management. We'll ask them, walk me through the list of contingent liabilities. Is there anything that you didn't include that you thought about but discarded? And maybe we ask them for a bit more detail about those so that we can make our own assessment. Now remember before I said that there would also be an auditing standard to look at, ASA 502. And that's this one here, where in regards to lawsuits, we will need to specifically ask management for a letter of inquiry from the client's legal counsel. What does that mean? This is really a form of external confirmation, because we are writing to the client's lawyers. If it's in-house, it's easy. If it's external, then typically the client will write to the lawyer and say, dear lawyer, please provide our auditor with information about our open cases, the possibility of whether we're going to win or lose, and the potential financial outcome. You know, we have to pay X number of $1 billion, or we might receive some money. So the client's lawyers are supposed to provide us with a complete list. So this is going to be one of those audit procedures where we're actually going to get evidence about the existence of any lawsuits, the valuation of how much they could be worth. They're going to give us all of the ones that specific lawyer is involved with, and then they'll also talk about, especially if there's shared liability, what our obligations might be. So this is one of these pieces where I'm going to use one piece of evidence and I'm going to get all of my evidence on the assertions at the same time.
Can you take this off?
You want to take his head off?
Yeah.
Okay.
I tried, but...
You tried? Oh, there you go.
Thank you, but I don't need it.
Okay, close the door, please. All right, after that interruption, this is one of those places where I'm going to get all of my evidence, all of my assertions from one piece of evidence. Now, what if the lawyer says, oh yeah, we don't have any cases? The other thing that I might sneakily, or not sneakily, but I would use my audit information to do is also look at legal expenses. All right, how much are they paying lawyers? How much is in that legal expense account at the end of the year? Does it seem to match up with what we're getting from the lawyers? Because if it doesn't, if the lawyers say, oh no, there are no lawsuits, but we're paying way more in legal fees than in previous years, then that's a good indication that something is up and maybe management is trying to hide something from us. So we're always, again, looking at all this evidence that we gather and say, does this make sense? Does this fit in with everything I know about what's happening in the trial balance and all of the other accounts that I've looked at as I've done my audit? And this is probably why this is a job really for managers and above, because they have the bigger picture. Usually as an audit junior, you're working on just your component. You talk with people who are working on your components and related components of the audit, but you might not have an understanding of what's happening over the entire audit landscape, I guess. So having this role being done by a manager, or this task being done by a manager who's overseeing the entire audit, will help them put those pieces of the puzzle together in case something doesn't look right. Now we come to one of the most complex standards related topics of the course. So far we've really talked about standards in their more general principles. ASA 560 is one of these really technical ones that I'm really going to ask you to read into a lot of detail. So now let's look at events that arise after the balance date. So what is a subsequent event? AASB 110 is events that occur after the reporting date. Remember, the reporting date is typically the date that you have as the end of the financial year. So for most of our firms in Australia, that's the 30th of June. So let's look at the definition from AASB 110, which is the AASB about subsequent events, but they call them events after the reporting date. I'd really recommend that you actually read AASB 110, and I've put the link in your class notebook. So it's things that happen after the 30th of June, good or bad, that occur between the end of the reporting period, that's 30 June, and the date when the financial statements are authorised for issue. Now, what is the process of that? The process is management prepare the financial statements, we come in, we do our audit, we provide our audit opinion, and then the financial statements are authorised for issue. So there's normally here 3 important dates. Date number 1 is the end of the financial year. Date number 2 is the date that the audit report is signed. And date number 3 is the date that the financial statements are issued or released. Okay, so this is about information that happens outside of the year. So it's after the end of the financial year, but they may have an impact on the future or on the accounting information that we're auditing. So there are 2 different types of events after the reporting date. A here, whoops, put my highlighter on, A, those that provide evidence of conditions that existed at the end of the reporting period. So something happened, we have something during the year and we get new information about something a transaction that happened back in the past. Okay, those events are called adjusting. So you'll see here it says they're called adjusting events. The second type, and the type I'm going to highlight in orange here, are those events that are indicative of conditions that arose after the reporting period. So the transaction or the event that gives rise to this new information doesn't happen until after the end of the financial year. Now this is where it gets a bit tricky, because AASB 110 says these are called non-adjusting events. All right, but in reality, for adjusting events means an adjustment to some, so you're going to see some sort of, let's do this in a color that's actually useful here. I'll do it in the red. These are things that are going to result in a number change. Okay, so on the profit and loss or on the balance sheet, something is going to be made in terms of an adjustment. For the non-adjusting events, those potentially have options of we might need to do a disclosure or we might need to do nothing. Now, why does it get complicated like this? It gets complicated like this because as auditors, we will require management to make adjustments, or we're going to ask them to make adjustments based on our findings in the audit. Those adjustments may be an adjustment that's a number, or it may be an adjustment to a disclosure, because to us, they are just as important as each other. If you have all your numbers are correct, but your disclosures are really terrible, I'm still going to pursue those as misstatements because of the disclosure and the presentation assertion. So this is where there's a bit of a disconnect between accounting and audit, where accounting says these are non-adjusting events and they're thinking about adjustment in terms of just changing a number. We think about adjustment in terms of making a disclosure. So always think about this from the audit perspective, but keep that in mind if you're reading AASB 110 and you're reading ASA 560. Now, whose job is it to actually identify the subsequent events? Well, it's actually management's responsibility. They're supposed to identify them, and then we are supposed to check what they have included. Of course, again, just like contingent liabilities, the big issue for us here is completeness. Have they included all of the subsequent events that need to be accounted for in the financial statements, or could they be missing something that might not help them financially? So what sort of things exist as examples of subsequent events? Well, the first one is a customer who owes funds, who owes accounts receivable, and they're placed into voluntary administration. So this is after the end of the financial period. So if that happens, are we able to collect all of that money? So that's a really good example, and it's a really common subsequent event, and probably one we're going to see a lot in COVID-19 times. A company might decide to announce a joint venture in the future. That's a subsequent event. It's news that's coming out about something happening in the future. Purchasing a major asset is something about happening in the future. Deciding to sell or close off part of their entity's operations could impact how shareholders are going to interpret information about the balance sheet, so maybe making them aware of that could be important. They might start or have progress in a lawsuit that could affect their contingent liabilities. So remember that specific one from before. And this is where these all will start to intertwine a little bit. And then you might have something like after the end of the financial year, there might be destruction of your inventory, your manufacturing facility. That could be something like a fire. It could be a riot, as is happening right now as I'm recording this across the United States. It could be an earthquake. A subsequent event could even be, though not typical, but COVID-19 is going to be listed for some firms as a subsequent event. If you had a 31st of March year end or a 1st of January year end and you hadn't quite put together your financial statements yet, then a lot of those businesses are actually adding COVID-19 as a subsequent event because it's going to affect their ability to operate in the future. So what auditing standard applies here? And you can see that I've got in the top corner, just right above me there, it says read ASA 560. Read ASA 560. I cannot reinforce this enough. You need to be able to read and understand this standard. Of course, as always, I've got my YouTube videos that go into those in more depth if you want to, but I'll also explain it right here. So ASA 560 is subsequent events, and I have to determine whether subsequent events are appropriately adjusted. Whoops, I've got the wrong pen there. Let me put the highlighter on. Adjusted, recorded, and or disclosed in the financial report. So I have to look at what management's done and said, is this the right adjustment if there's an adjustment needed? Is this the right disclosure, or do we need to do nothing in those circumstances? So the assertion most at risk when it comes to subsequent events is, again, completeness. Do we have all of our subsequent events included? Is management trying to hide a subsequent event, just like with a contingent liability? So completeness is a real issue around these end of audit processes. Now, the application of ASA 560, which I'm going to expect you to do for our next quiz, requires a deep technical understanding. The standard isn't hard, it's just a little bit complicated, but I'm going to uncomplicate it with some simple rules that you should be able to follow to help you in any single subsequent event situation. So step one in applying ASA 560 is in what period does the event occur? So if it's something like the factory burning down or a customer going out of business, it's when did I find out about this information? And there are 3 different periods here. I'll use black first, or maybe I might use purple, that'll be easier to see. So period 1 is anything up to and including the date that the audit report was signed. Okay, so here I've got the 1st of September as the date the audit report was signed. So period 1 is anything that I discover during the financial year or in those first few weeks of the audit until the audit report is signed. Okay. Period 2 is the very small window between when I sign my audit report and when the financial statements are issued by management. Okay, now that window used to be weeks and weeks. You might find that in practice, this window might even be as small as 1 day. So period 2 events are becoming more and more rare. Period 3 is I find out about something in period 3 after the end of after the financial statements are issued. So you might go to a lunch after the financial statements are issued. It's a team lunch with the auditors and the client and their accountants, and say you're in the bathroom, you're doing your business, and then you hear some people that you know as accountants walk in to the bathroom, and you hear one of them say, "Oh man, I am so lucky that the accountants did not find that fraud, man, because I could have been in real trouble." There, I've discovered something in period 3. So my first question is, in what a period do I find out this information? Then my next step is I have to figure out, was this related to a transaction that happened during the year, or is this something that happened after the 30th of June? Now, it's really important that we get these dates, because once you get these dates sorted out, knowing what to do becomes really easy. But trying to identify the dates is really hard in the beginning. We have to be really careful because what we have to do is really different in each of these periods. ASA 560 says do one thing in period 1. And then your responsibilities are different again in period 2, and then your responsibilities again are different in period 3. So the next bit coming up is going to be an excerpt out of my ASA 560 explainer video that breaks down what you're supposed to do in each of these situations. And I really suggest students try and draw a flow diagram out of what I'm talking about to make your own thought process about how to actually figure out approaching these types of questions. I'm going to draw a little timeline here. All right, so we have the date of the financial report, which is essentially the end of financial year. Then we have the date of the audit report, and then we have the date the financial statements are issued. So let's break these down into components. Date of the audit report, date of the end of the financial year, and the date the financial statements are issued. So I'm going to do period 1 in blue, okay? So anything up to this point here is period 1. And I'm going to highlight in the video in relation to these colors. Anything between the date of the audit report and the date the financial statements are issued is period 2, and then the yellow is anything after the date of the audit of the financial statements. That's period 3. Okay, so I'm going to highlight these in these different colors: blue for P1, green for P2, and yellow for P3. So let's go back over here, because this one is about events occurring in P1. All right, and it's very clear about what we should do. We have to go out and we have to get sufficient appropriate evidence that we've identified all of the subsequent events up to the date of the audit report that require adjustment or disclosure. Okay, so what we have to do in this period is that we have to search. We have to look for items in this area and then conduct audit procedures. Now, what sort of procedures do we need to do? There's a specific list here. Understand how management knows that they're going to have subsequent events. Talk to management about whether there are any subsequent events that we should know about. We'll look at a whole lot of documentation to see if we can identify any more, and look at any subsequent interim financial statements. So what happens if we find events that require adjustment or disclosure? I'm going to talk to management about making those changes and whether they're appropriately disclosed or recorded within the financial report. I also have to ask management for a written representation that they've given us all the information about subsequent events. So remember, written representations are all about giving us data on completeness, we ask management, have you told us everything? So in period 1, we have to search for evidence about subsequent events and request management make any adjustments if we find some. The next one we're going to look at, which is down here in the green, is going to be period 2. All right. Now this is really important. The auditor has no obligation to perform any procedures regarding the financial report after the date we sign it. So that means that I had to search in period 1, but I don't have to search in period 2. Okay. But it has a little caveat. If a fact becomes known to us that we should have known at the date of the audit report, then I have to go through and do these 3 steps. Talk with management, consider whether we need to change the financial report, ask if management are going to make the change, then go ahead and reissue a new set of audit opinion documents. But in this one, remember, I don't have to search for anything, but if someone brings it to my attention, a client raises it or somehow I discover it, I should have known it about the date of, I should have known about it at the date of the audit report, then really I have to go back. And the reason I have to go back is because I should have been able to find this out, all right? But I didn't. So I have to go back and investigate or correct what is potentially my mistake. If I don't do anything, there could be a misstatement that's in the financials that I haven't actually done anything about. A bit more here on period 2. Remember, period 2 is our green period. I have to provide a new audit report. This next paragraph here, that's only for Australian firms. Okay, so let's scroll down to this last one, which is the yellow section. And this is period 3. Things that happen after the financial report has been issued, released to the public. Now you might notice there's some common words. The auditor has no obligation to perform any procedures after the audit report. So we don't have to search for anything. However, the same line comes up. However, if after the financial report is issued, a fact becomes known to the auditor that had it been known at the date of the report, I would have made a change. All right. So again, this highlights the idea that had I known about it. All right. So the key question again, when it comes to this particular instance, and the reason why I have to do something is because in P1, I should have discovered this. All right. But I didn't. Therefore, the onus is on the auditor to go back, discuss with management, and then go through and investigate. So I have to search and say, well, do we need to have a change to the financial report? What does management intend to do? If management say, yes, I'll make a change. So they're saying big tick to making the adjustment, then we'll go and we'll do the audit procedures necessary to make sure we've got the right assessment. Then we need to consider issuing our new audit report, all right, with an emphasis of matter. Now that audit report might still be unqualified, but it might have additional disclosures. It must have an emphasis of matter to say to people, hang on, we issued an audit opinion before, now we're taking it back and this is the new one. So this is the new one that we should discuss. But what happens if management don't want to recall the financial statements, recall and revise? Well, then I have a specific responsibility. So if management don't want to make a change, then I shall notify management and those charged with governance that I will seek to prevent future reliance. So I've got to stop people using the financial report. I could do that by making an announcement to the stock exchange. All right. I could make an announcement in the newspaper or media. All right, because I want to say to people, hang on, don't use our audit report. Management have raised an issue. You might even need to talk to your regulator in this specific circumstance. So what about obtaining a management representation letter? This is ASA 580, and this is a really critical piece of information to get. So what is a representation letter? Well, it's a letter from management to the auditor. Really important, to the auditor. This is not something the auditor writes to management. We're going to talk about something a bit different called a management letter in our last week. But the representation letter is from management to the auditor, and it contains 3 pieces of information. The first one, management say it's their responsibility to prepare the financial report. Corporations Act says this, the auditing standards say this, the accounting standard says this, the engagement letter says this, the director's declaration says this, but again, this is one more chance where we remind them it's their responsibility and we provide suggestions. The second thing is that we provide auditors with all of the relevant information per the engagement letter, so that management, when we've asked for information, they've given us complete information. They haven't hidden anything or omitted anything when they've given us things that we've asked for, and that they also confirm any evidence that they have provided to us verbally. All right, so quite often we might get information, we make an inquiry, we talk to the manager, we talk to the CFO, and sometimes there's not a great internal or external source of documented evidence that we can rely on to confirm that verbal report. So the written representation letter is also a way in which we ask management, because sometimes we'll list them. Here are the things that you've said to us. Can you please confirm that these are all correct? So that gives us extra reliability of our evidence. So does the auditor have to obtain one of these letters? Absolutely yes. ASA 580 says we have to collect the letter, and without it, we don't have sufficient and appropriate evidence. That's going to modify our audit opinion, so make sure that you obtain one before you sign the audit. This is something that usually goes straight to the partner, unless maybe the partner has asked you to collect it from the management of the firm. So what about evaluating all of our audit evidence? How do I know if the financial statements are free from material misstatement? I need to gather all my evidence and figure out what is it telling me. So what sort of audit evidence will we have accumulated? We'll have lots and lots of documents, lots and lots of work papers in our electronic database, but we have to gather evidence on whether every single account that we think is important as material is free from material misstatement. So remember, we need to go back and look at our measurements or our assessments for our materiality. So what was our dollar value for materiality, and were there any qualitatively material issues that we should look at? Remember, some things might be qualitatively important, like related party transactions that might not be big in dollar value but are qualitatively really important. So I have to say, do I have evidence? Does each of my accounts meet my assertions? I can't just pick one assertion for the accounts and test it. I want to try and gather evidence on all of the assertions and then pull that all together. Now, what counts as a misstatement? Well, ASA 450, which is about identifying misstatements, says that misstatements are differences between the reported amount, classification, presentation, or disclosure of something, and the disclosure, classification, amount, presentation required by the applicable financial reporting framework. Now remember, our applicable financial reporting framework is our AASBs. So we're saying the reported amount is the amount that's prepared by management. Okay, and the amount that is calculated as what is suitable according to the applicable financial reporting framework is actually the amount that we think, that the auditors think, is the correct amount or the correct disclosure or the correct classification in the financial statements. Now, what does ASA 450 actually tell us to do? Well, and I realize I've got an error here because I don't have the standard number. ASA 450 says we must create a list of misstatements, and quite commonly the auditors will call that a schedule of misstatements. That'll have every misstatement from typically organized biggest to smallest, or maybe in different types of accounts. And for material misstatements, I want to make sure, and this is not covered in the standard, but from our practical experience, you need to make sure that you've got evidence, all right? Evidence to support what we think the number should be. What did we test? How did we test it? How many of our sample? So details about how much of the population that we tested when we did our sampling. How much dollar value, if the account is worth $20 million, if I tested $18 million worth of transactions, then I'm pretty sure that what I've got is correct. Because managers want to believe that their number is the correct number. We want to believe our number is the correct number. And it's not an easy process to say to management, here, change your accounts. So where there is a clear mistake, they'll be like, yeah, sure. But where there is more what we call judgment, let me change my pen here. Or if it's something related to an accounting estimate, we need to make sure we have our expert opinions, we've got all the evidence to be able to convince them, yep, this is the correct amount. In the next topic, we're actually going to talk about how do I present this list to management? What do I talk about? What are the things that I need to consider when I'm negotiating with management? Because this is something none of the textbooks talk about, but is really important. We also have to make sure, and I'm going to jump to the third point here instead of the first one, how important are disclosures in comparison to the numbers on the income and the statement and the balance sheet? It's just as important. So we need to make sure that we evaluate the presentation assertion and look at the disclosures in the notes. Do these numbers add up to the numbers that are mainly reported in the income statement and the balance sheet when you're looking at segment reporting? Are all the disclosures correct in accordance with our, oh, that color's not very clear, in accordance with our AASBs? Now, there are some accounts where disclosures come in a lot more, and there's a lot more useful information in those accounts than in a number. Those sorts of things, obviously, we know already. Contingent liabilities and subsequent events, SEs, but other things that fall into this category are things like related party transactions. More meat and detail in the notes than, there's no number that sits in the income statement of the balance sheet about related party transactions. So related party transactions, other sorts of accounts like, do you remember from ASR looking at financial instruments? And financial instruments has such complicated disclosures about risk and profiles and what sort of protections of risk are going on in the company that the disclosures can be quite complicated, which is why we often need some expert assistance if we get a little bit stuck. Now remember at the beginning of the audit we looked at analytical procedures, and to jog your memory in case it's been a few weeks, we looked at things like ratio analysis, and we looked at like horizontal and vertical analysis, and all of that was to help us identify risks of material misstatements. All right, what in the numbers to the accounts looks a bit funny and out of place and might indicate to us that there's a potential risk that we need to investigate in the audit. Well, we're back to doing analytical procedures at the end. Now, remember the auditing standard here, let me add it in, is ASA 530. About analytics, we learned about analytics at the planning stage, we've learned about analytics at the substantive analytic phase, of substantive testing phase, and now at the final phase. So what we do is we take our adjusted income statement and balance sheet. So we had the client's version, and then we made all of our adjustments to give us what we think should be the most appropriate answer under the applicable financial reporting framework, which is our accounting standards. And then what I want you to do is, on an audit, you calculate the ratios again. You do exactly the same ratios, okay? And then you do a comparison. So why do you do the comparison? Well, what should you expect to see? If you found all of the misstatements that the funny fluctuation or the funny ratio said to you, oh, something's up here, warning, warning, red flag, then if you found all the misstatements, the fluctuation should disappear and your ratios should look normal. all right, or expected or similar to what you would see in that industry. What if there is still an unusual fluctuation? If there is still an unusual fluctuation in that ratio, that means there's a potential for a misstatement that you have not identified, okay? So let's say in the early days, you found something that said that sales was up by 25%, okay? But you found cost of goods sold was only up by 5%, right? That looks a bit unusual. What's going on there? Those things should move in the same direction because we know that the journal entry is debit cash, credit revenue, debit COGS, credit finished goods inventory, right? Those two journal entries, 1, 2, 1, 2, that's how it always works. So you think, okay, what could be going on here? You ask management, they say, look, we haven't changed our supplier, we haven't changed our process for manufacturing goods or creating goods. The price of the item has just stayed the same. So you go, okay, if prices have stayed the same, then COGS, something is going wrong here. You might look into the control systems. Well, there's supposed to be an automatic journal entry. When you make a sale, the journal entry is meant to happen. When you go in there, you might find some issues. Let's say that we found two things. We found a fraud of fake sales, all right? And we removed the fake sales. So if we've removed the fake sales after we've done the audit, then we go back and we run those same amounts. Cost of goods sold, 5%. And let's say sales, let's rub that out and do this more in line. Sales has increased by 15%, still a 10% difference. Management say to you, look, we haven't changed prices. Nothing has changed. We can't explain this. If at the end of the audit you still have, trying to remember which way I point, that situation right there, then something is still wrong. There is still a misstatement. So this is your last chance to go back and see a flag that might indicate a misstatement that you need to investigate. So you need to make sure that you do these at the end. If you found everything, anything unexpected should just drift away, or you've got now appropriate explanations and evidence to support things that look like they're moving in the wrong direction. The last topic of our module is going to be assessing going concern. And the real question is the client going to survive over the next 12 months? And this is going to be a huge issue. The Australian Auditing Standards Boards, the Americans, the PCAOB in the United States, in the UK, the International Federation of Accountants and the International Auditing Standards Board have all issued specific guidance about going concern. I'm going to link some of those within our class notebook for you to have a read of, because this is going to be a really important issue. So what are management supposed to do? AASB 101, and you may notice I've referred a bit to AASBs, management shall make an assessment of the entity's ability to continue as a going concern. A going concern means that they're able to pay their debts as they fall due by generating revenue. Okay. Now, if we think, yep, we can do that, they prepare the financial statements on a going concern basis. That means we use historical cost, right? It's a traditional accounting process. But if the entity intends to liquidate or cease trading or has no alternative but to do that, then we cannot use historical cost and the going concern basis. We'll need to consider an alternative basis for the financial reports, and that's typically then where you think about recording something called liquidation values. All right, so rather than using historical cost, we say, what is the value of selling this right now? How much could we liquidate it for at that immediate point in time? Now, traditionally, the idea of going concern, you look back to the traditional definitions, it was continue, into the future, and the future was just forever. Now, of course, trying to look into a crystal ball is pretty difficult, but typically a going concern assessment is for one financial period, and one financial period is typically 12 months, all right? But it's one financial period. But for us, that's typically 12 months. Okay, so if we decide, look, the company's not going to continue, that's pretty common in a COVID era where some businesses have just decided, yep, I'm just going to close, then we have to disclose that fact. Oops, that's the wrong color highlighter. Let me just fix that for you so that you can actually read it. Disclose that fact and the basis on which you prepared the financial statements, which may be those liquidation values if you can get them. Now, ASA 570 is one that I definitely want you to go away and read. It has a really great flowchart. I'm going to show you that flowchart and what the responsibilities are. So management make the assessment. Yes, we think we're a going concern, or no, we think we're not. Then we have to assess management's assessment of themselves, which realistically means we need to go and do our own fresh assessment. So we're going to discuss with management any events that might create something called material uncertainties. Now, material uncertainties are things that could result in the closure of the firm, a really huge lawsuit. If you're in the hospitality industry, the inability to have customers with COVID-19, or the inability to get supplies to make your product because they come from somewhere that's completely locked down. So we have a lot more examples to talk about in terms of situations in which may create material uncertainties, and I'll add some more examples or links to some examples of audit opinions with material uncertainties for you in your class notebook. So how far into the future do we consider? We say, remember I said 12 months, but it's 12 months from the date of the audit report. Okay, it is not 12 months from the end of the financial year. It's 12 months from the date of the audit report. So essentially, I'm saying, I think this company is going to continue for 12 months from the date I sign this report. Now, what does that mean if you signed a report on the 1st of January for a 30 June year end? Oh, actually, so here's an example of where that could get really tricky, and where often people who don't understand auditing will say, well, why didn't you recognize something earlier? So imagine, so I went ahead one point there. So imagine that you were auditing a company that has a 30 December year end. Okay, and with that 30 December year end, what you did on the, let's say, 5th of January, let's say you were super organized with the audit report that year, and on the 5th of January, you were done with your audit, and you said, look, yep, this is a hospitality company, they provide catering to the airline industry, for example, and we think, yep, going concern. 2 months later, the whole airline industry is pretty much ground to a halt. Lots of airline caterers are having real troubles. People will say, but why didn't the auditors see this? Well, all we can do is give our opinion, our assessment at the 5th of January. At the 5th of January, the university was talking about how might we offer learning online for students who couldn't leave China. We weren't thinking that there would be a border lockdown and no one would be allowed to travel, and we would have community transmission, and we would have all of these things that we have now. So we can only give our assessment based on what we know at the date that we sign our audit report. We're not held responsible if we don't say something about going concern, because we couldn't have known any better at the time. Now, if there is an issue, like most firms will have an issue right now with COVID-19, we say, what is management's plan? Does it seem reasonable? What are the assumptions management are making? If you said, oh, yep, I'm a luxury goods manufacturer, I make fancy handbags, and I think I'm going to increase my market share by 200%, I'd say that's not really reasonable. If I was a phone manufacturer and I said, yeah, people aren't buying as many new phones, but we're going to put money into marketing, and that's going to grow our market share from 2% to 20% in a year, again, I'd say unreasonable. And if management's plan doesn't seem reasonable, we actually are obliged to say to shareholders, management have a plan, but we don't think it's very good, because our responsibility is to the shareholders to give our opinion on whether management's assessment is appropriate. So if you're thinking, oh my God, I'm a bit lost, this appendices from ASA 570 is fantastic. I don't know why they don't make one of these for ASA 560, because it would just be so much more useful. But if you have a going concern issue, you work through this particular flowchart. It's pretty easy to read. Is there a material uncertainty? Have they used the going concern basis? Have management made disclosures? The biggest issue around going concern is where we think the going concern, where management and the auditor don't agree. So management says, yep, company's going down, we're going to close the business. I'm not going to use going concern as the basis. I'm going to use the idea that we're going to liquidate. I'm going to use a different base for my accounting. I'm going to disclose all that. Then the auditor's going to go, yep, you've made all your disclosures, sweet, that you're doing the right thing. Where it's going to become difficult is where managers say, oh yeah, there's no problem. And auditors say, yeah, there's a material uncertainty. If management are refusing to disclose, then that's going to have an impact on the audit opinion options that you see along the bottom in those blue boxes. So work through each of those options and then apply that to the exercises that are going to be attached, where you're going to work through some different scenarios given data and given information and figure out what should happen at the end. So to sum up, it's quite a lot that we're talking about this week. Number one, identify any contingent liabilities. Do you have to have any disclosures? What needs to be included? Consider some subsequent events. Are there any adjustments or disclosures that are needed? What needs to be disclosed? When did you find it out? Make sure you get that representation letter for management to confirm they know that this is their responsibility. Consider the evidence as a whole, right? We're going to talk more about stepping back, but we're going to look at all of our misstatements. We're going to use our analytical procedures to do some of that, and then evaluate going concern, which is something that normally is not such a big deal, but in times of severe financial recession, this happened around September 11, this happened, so that was back in 2001, also back in 2011 with the GFC, and now in 2020 with the COVID-19 financial recession that we're inevitably going to experience. So, one more topic to go. Congratulations, yay! So the last topics are going to be about evaluating and negotiating the adjustments to be made with management, what opinion we should give, and something called Key Audit Matters, which is about insight into the auditor's brain and thinking as we go through and prepare our audit report. So thank you very much for watching. If you have any questions, as always, pop them in the channel, and I will see you all soon.